Yeah, thanks, Tim. And thanks everyone for joining. So DNR Capital, quick overview of us. We're a Brisbane-based asset management business. We've been around 20 years, over 5 billion of assets under management. And we launched this new emerging company strategy 3 years ago. And this is about putting together a concentrated portfolio of high quality stocks that we think are attractively priced. And that typically leads to sort of a style neutral outcome through the cycle. We're long-term investors, very much taking that long-term view, looking at over the next sort of 5+ years. I think that's a key advantage in the small cap space. It's incredibly inefficient. The market consistently overreacts to positive news, to short-term news, but it's important to make sure that you look through that and really take that long-term view. And we're concentrated. That's how we've been investing at DNR for nearly 20 years. Around 30 stocks in the portfolio, making sure that we're really driving the alpha from our best ideas. So every stock really competes for capital in the portfolio. We launched this 3 years ago. We've currently got around 160 million in the strategy, and we've got capacity up to around that 950 million level when we'll sort of close it off. But obviously, staying disciplined on capacity is essential in this part of the market to maintain that sort of performance, that consistent performance for clients. Then we just flip to the next slide. I'll just go through some of these quickly so we can get through to some of the more interesting in terms of portfolio positioning. But you can see here on this slide that the team, myself and Mark, my background, I've been with DNR for the last 4 years. So I spent 10 years in London. I was a portfolio manager at Schroders. I was over there for 7.5 years, and I managed a European equity fund, €1.5 billion fund there. And prior to that, I worked on the sell side at Citi, covering small cap, healthcare, and also mining stocks. Originally started off at PricewaterhouseCoopers in the accounting background, valuations background, where I also worked with my co-PM Mark at PwC. If we flick to the sort of the next slide. We can then sort of now dive into the strategy and the recent performance. So we launched the fund. We've just come up to the 3-year anniversary, and I think performance has been solid through that time. And I think what sort of highlights is that DNR, we've been investing with our investment philosophy of really looking at those high quality businesses in the market that we think are attractively priced. And I think it's even more relevant in the small cap space because this is a very inefficient part of the market, and that's certainly coming through in the numbers since we've launched it. A lot of value to be added through sort of that detailed bottom-up stock selection process. And obviously, it's been a very volatile environment over this period too. We've obviously seen, last year been incredibly interesting period in terms of the sell-off with COVID and the recovery since, and we've sort of navigated through that successfully. So I think flicking to the next slide, we'll just sort of now talk a bit about the market outlook and current portfolio positioning. And it's been quite interesting because if we look back over the last sort of first half of last year, it was a flight to quality in the small cap space, but and a flight to some of sort of those secular growth stocks. But what we've seen in sort of the last sort of 6 months is quite a sharp rotation in the market, and especially this year. And I think now more than ever, it is really a time to be positioning, we think, for the recovery, because I think the obvious question now is where are the opportunities in the small cap space in Australia, given such a sharp bounce we've had since the lows in March. And we think it very much is by taking that long-term view and positioning for the recovery. And certainly we will see a lot of volatility in the short term, a lot of uncertainty with the vaccine rollout. But the examples so far in markets such as like Israel, and we're seeing a similar trend starting to play out now in the UK and in the US. The vaccine is very successful. We're seeing a sharp fall in deaths and in cases, and that's allowing us to start thinking about a more normal environment that sort of corporates and households will be operating in into the second half of this year and into 2022. On the next slide, we just sort of show in terms of the policy backdrop as well, in terms of what we've seen, quite an unprecedented step up in terms of monetary support from the major central banks, pretty unparalleled compared to even what happened during the GFC. And also on the slide on the right there, in terms of the fiscal spending that's coming through. The baton really being now passed from monetary policy to fiscal policy. We're obviously seeing that with the stimulus coming through in the major economies, the recent stimulus package approved in the US, and along with things like high household savings rates. We think that the economy will snap back very sharply into the sort of second half of this year and into 2022, given a lot of this policy support that we're seeing. If you click onto the next slide, this has sort of significant implications now for where we see the opportunities in the small cap space, because I think when there was a lot of uncertainty around the macro outlook, a lot of uncertainty around COVID, the market has been gravitating towards these secular growth stocks that have been delivering these very high revenue growth in the software, payments, healthcare, the online-based businesses. You've obviously seen a lot in the US as well, the valuations a lot of the tech stocks have reached. It's no different in Australia. This chart on the left shows the PE of the high PE, the relative valuation of high PE firms versus the ASX 200, and you can see it's sort of been at a record high level. As we start thinking about a reopening global economy, as we see an end to this lockdown, that's opening up and broadening out a whole opportunity, sort of new opportunity set of stocks in some of those more cyclical areas that are now seeing improving volumes, improving pricing, better operating leverage coming through, and that's providing a more credible set of stocks to invest in versus some of these higher PE secular growth stocks that the market was hiding in when the outlook was uncertain. And so although we've seen some rotation, we think this rotation has much further to go, because as that chart on the left shows, we've only really sort of scratched the surface in terms of some of the rotation that we've seen out of those very, very, very highly rated stocks. If we flick to the next slide, just we can see here, obviously valuations are important, but we don't want to dismiss quality still. This slide here shows the range of returns across the small cap space in terms of return on invested capital. And it highlights that there is a lot of dispersion in terms of quality across the small cap space. A lot of low returning businesses you wouldn't want to invest in, generating negative return on invested capital. You really want to be hunting in the top left. These are the businesses that are actually creating value for shareholders. And it's for this reason, if we on the next slide at DNR, that we apply this consistent quality framework to each business. So we rank businesses based on these 5 key quality characteristics. We think these are the characteristics that define a good quality business in terms of a company that has a strong industry position, strong balance sheet, good earning strength, good management, and sort of low ESG risks. And then flicking to the next slide there. So in terms of then, if we look at portfolio repositioning of what we've been doing in our fund over the last 6 months, I think there's definitely been an opportunity to reduce some of these more expensive areas of the market, some of these secular growth stocks that have been trading on very high valuations. Many of these have been priced for perfection in terms of very high valuation multiples, and also the growth expectations in forecasts have reached very high levels also. So we have significantly reduced our technology weighting, selling out of some of the names like Technology One, Zip, Tyro, and also exited out of Nanosonics as well, and some of those expensive healthcare stocks. And where we've really seen the opportunities is in some of those more value and cyclical areas of the market. And that includes increasing the materials weighting, some of these companies where we think will benefit as the recovery comes through, also increasing the energy weighting. And we still retain some key overweights in that consumer discretionary space as well. Some of these companies that we think will benefit from the reopening that I'll show you on the next slide. I think definitely some of these reopening stocks look still very interesting to us. I mean, some of these were the ones that have been impacted the most in the short term, but where we still think the long-term outlook is still very, very positive. And these are the ones that have been hardest hit. There has been a lot of focus on some of the physical retailers. We think some of the key opportunities some of the online retailers have been hit, seen some of the benefits in the short term. But where we think, in terms of the reopening and some of the pent-up demand, it isn't some of those physical retailers like Lovisa, or in travel, like corporate travel management, in the education space like IDP. And a key focus for us as well has been focusing in on some of these companies that we think haven't wasted the downturn, they haven't wasted the crisis. Something we saw coming out of the GFC, those ones that really took advantage of the downturn, they had the strong balance sheets going into the crisis. That allowed them to really benefit from those market share gains during the recovery. And Lovisa did a bottom of the cycle acquisition of a company in Europe. Corporate travel have really accelerated their growth through a bottom of the cycle acquisition in the US, and IDP have also invested through the downturn in their digital infrastructure. They now have the largest pipeline of students they've seen. So we think all these companies will do very well during the recovery, given the good action taken during the downturn. That allowed them to take those market share gains when the recovery does come. And another really interesting area we've sort of been obviously adding to, and I touched on it before, is in that materials space. Over on the next slide, you can see in terms of there's been lots of discussion in the market recently. Are we at the start of a new commodity super cycle? Well, certainly, I think you do need to be selective depending on the commodity you're looking at, but the outlook does look very positive, and the most positive potentially it has done for some time, given some of the supply side constraints that we're seeing across the industry. The mining companies haven't really been adding much new capacity, but also on the demand side as well. We've got some numbers up here, for example, on the whole decarbonisation thematic. Goldman Sachs suggesting that the path to decarbonisation could require about 16 trillion of investment. That exceeds what China spent on the whole urbanisation of China in the 2000s of 10 trillion. So this is quite a game changer for the industry. The whole shift from renewables towards renewables, the shift from the combustion engine to electric vehicles. There's a number of companies that we think will benefit from that in the commodity space here. And that sort of feeds into on the next slide. In terms of one of the key overweights for us in the portfolio, currently overweight materials. I don't think this is really a space you could ignore in the small caps. It's around 20% of the index. I think you do need to be careful investing in mining stocks in the small cap index, really focusing on those high quality companies, the ones that have a low cost position, generating strong cash flow, have that balance sheet protection, good management. But we think there's some really great opportunities in this space currently, given the sort of the structural outlook we see for the commodity space. We currently have quite a broad spread of commodity exposure in the portfolio. That pie chart on the sort of bottom left highlights that. It's sort of spread across rare earths, mineral sands, iron ore, nickel, lithium, focusing on those sort of high quality names. And you can see on the right there, in terms of the average metrics for the mining companies we're invested in, we're getting a double-digit free cash flow yield. They're on an average net debt to EBITDA of -0.4, so average net cash balance, generating high returns, strong mine life on average, and bottom of the cost curve. So we think some very interesting opportunities in the mining space currently. And I think if we flick to the next slide, I think this is the last one, so I'm just about out of time, but just sort of brings together some of the characteristics of the portfolio currently. Portfolio is trading on around 23 times, slightly ahead of the index, but we've got a lot of companies on depressed earnings at the moment, given that sort of recovery potential, some of these cyclicals on depressed earnings. But the portfolio overall generating returns above the benchmark, gearing well below the benchmark, average net cash balance overall. And you can see we've got currently 27 stocks in the portfolio and sort of spread across that sort of small to mid cap part of the index, nothing below 500. So we are very focused on that sort of liquidity as well.
Thanks, Sam. Perhaps time for a couple of questions. Given how active the market is at the moment, particularly in terms of capital raisings, how many opportunities are you seeing in terms of brokers presenting, capital raising opportunities too?
Yeah, look, there's no stream of IPOs coming across the desk currently. Many sort of opportunistic ones. We have looked at a lot of them. But I think you still need to be very careful at this point in the cycle in terms of making sure that you're staying disciplined on quality and valuation, because we have seen a number of failed IPOs of late. We've obviously seen what's happened with Adore Beauty, Nuix. Some of these companies come on very high valuations and then sort of disappoint later on. We're now starting, even in the mining space, we're sort of seeing some opportunities come up. Obviously, some investors looking to take advantage of some of the valuations out there currently. So look, there's definitely no shortage at the moment, but I think you do need to be very careful, put them through the same process, make sure you're confident on the quality and also the valuation, given the information is usually stacked on the side of the seller rather than the buyer with the IPOs.
And it's certainly that sort of market. And how much do you rely on broker research, external research?
Yeah, that's the interesting thing in the small cap space. I think overall, the small cap coverage from brokers is pretty poor. It's a pretty inefficient part of the market. This is the area where it's sort of been immune from index funds, and there's really that opportunity to do the work yourself, build up that detailed insight on the businesses and the companies ourselves, and that's certainly sort of the core part of our process. The brokers, we tend to find overall there's a fair bit of turnover in the banks. You'll find some selected people here and there, but I think overall it's a pretty thin coverage across the banks in the small cap space.
And just one question from an advisor that's come in. Can you talk to us just briefly on terms of how you manage risk, sector risk, liquidity, etc.?
Yeah, look, I think it's a great question, and certainly when we think of risk, we are thinking of the risk of capital loss, and we're also thinking of the risk in terms of making sure we're sizing positions in terms of the quality of the business and the valuation upside that we see in a company. So we manage risk from a bottom-up point of view by investing in companies that are high quality in terms of strong industry positions, strong balance sheet. Bulk of our companies all sitting on net cash. Companies with management that are high quality, that have a lot of alignment with investors. Companies that are generating strong cash flow. And then from a portfolio construction point of view, we want to size positions and really put the most capital behind those stocks that get the highest quality score, but also where we see the maximum valuation upside as well. So that portfolio construction piece in terms of sizing positions is key from a risk management point of view as well.